behind this. Coming into this year, it became commonplace to say, hey, post-election years, they usually have a rocky start. Well, we did, to an extreme this year. So this is current year-to-date movements in the S&P 500. Big drop on really one of the worst years on record in terms of how fast we went down in the first few months, and then recovered. It sort of rhymes with the general cadence of a post-election year. This is the average there. Now, note the different scales on the left and right axes. It shows you that we have much more amplitude here in the 1 year relative to the average. But it also shows really not a lot happening on average until you get into the fourth quarter in these post-election years, maybe when some policy stuff does start to clear up.
It is interesting, and it puts it in context in terms of some of these patterns, historical patterns that we can draw back to. That being said, I mean, the spike we saw in April in volatility and then the fall back off of that, and similarly, or I guess inversely, what we saw in the stock market too in terms of the drop and then the recovery, how does that speak to maybe the market mechanisms themselves, just given the fact that the velocity of the moves have been so dramatic?
They have. It's tough to handicap exactly whether you have sort of the accelerants in the market, or we have a more of a spring-loaded market now because you have so many instruments to instantly express a short-term view. It is possible. I mean, we did only have for a flash a 20% intraday decline in the S&P 500 and didn't even close below that level, and yet you did see a historic jump in the volatility index. I think part of it is just exactly how much of a surprise the news was. And it was a piece of news which was the shape of the proposed tariffs that you really couldn't handicap in advance. So the market process for trying to price in advance of it was not really that reliable. And I think that's one reason we did see it. And therefore, you had a big flush. It looks like one of those big event-driven scares that does have a pretty decent recovery as opposed to a recession-driven downturn, but obviously remains to be seen from here, John.
All right. Mike, thank you. Now let's bring in our first guest who expects the market to remain choppy this year, but says the bottom is in. Morgan Stanley Wealth Management Managing Director Dan Skelly with us now. Dan, welcome. So you also seem to think the highs are pretty much in and we're near them overall. So how should investors position themselves now to be ready for 2026?
Sure, John. Thanks for having me. And so, look, this year is shaping up to be like a range-bound environment, which at its core frustrates everyone. Right? The bulls get frustrated that you don't sustain much momentum past this kind of 5,900 level. The bears get frustrated that they can't push their shorts much below the 5,200 level. So we are in a range, and it's capped by this idea that the full extent of earnings downgrades hasn't really happened yet. We don't know the final clarity around where tariff levels will finally net out. And in the best case scenario, they're going to be substantially higher still than they are over the last several years and decades. And then lastly, the low end of the range holds because of continued labor market resilience in the economy, of this idea that the AI adoption cycle is just starting to take hold, which will eventually be good for the earnings cycle, and the market's going to sniff that out. And last but not least, the White House team has shown some flexibility around the most maximal positions.
So that's talking S&P and range bound. What about this mix between domestic and international? International has been doing better over the last couple quarters, especially to start 25. Should investors believe overall that despite all of this tariff uncertainty, that shift toward better international performance continues or no?
So from the institutional perspective, Morgan Stanley has just put out its mid-year update, and the team is preferring U.S. stocks over rest of world, specifically U.S. over Europe. And look, European equities, which you had referenced, had been on a really big hot streak, could also see potential growth in earnings downgrades as the trade battle ensues. And the last thing I would say is you haven't really even seen a pickup in sustained capital flows. I think there was this massive chorus, this very loud chorus in early April around sell everything America. And we just haven't seen that corroborated by the actual data in terms of inflows. Flows into the U.S. market are still tracking pretty strongly year to date. I guess the very last thing I would say is coming back to tech. In the last quarter, we saw the Mag 7 have its best upside surprise in earnings really in the last 2 to 3 quarters. And that clearly is another area of uniqueness of defensive and offensive attributes that other parts of the world don't have.
So if we stick with tech here, how do you factor in the anticipated effects of AI to this market and to the economy, and the realization of all of the investment that we've seen thus far. Because on the one hand, Jamie Dimon, in my interview with him on Friday, was saying, we're not going to see it, at least not this year, not yet, any deflationary effects from AI adoption. On the other hand, I was speaking to tech investors, including Joe Lonsdale, who says, look, AI is going to spike productivity and it's going to more than offset the impact of job losses as companies adopt AI too. How do you think about it?
Such an excellent question, Morgan, and a couple things to unpack there, right? So in the first quarter, the Magnificent Seven as a group reported 32% year-over-year earnings growth. The S&P 493 was around 8%. So you're still seeing 4 times the amount of growth coming from Mag 7 than the rest of the market. And look, importantly, as you alluded to, let's go back 6 to 9 months ago. The Mag 7 included not just the beneficiaries, but the biggest spenders related to AI. And as that group took a breather 6 to 9 months ago, people were still waiting for the return on investment. Now you're finally starting to see that play out, not just, again, within that same group of the spenders as well as the beneficiaries, but it's broadening out. You're seeing it in software. You're seeing it in consumer internet within the tech space. And then to your question, we do think coming in next year in 26, you're going to finally start to see the Fortune 100 start to better quantify and thus validate AI adoption. That's going to play out across financials, manufacturing, and healthcare.
Okay, Dan Skelly, thanks for kicking off the hour with us. With all
Thank
the
you.
major averages higher, the S&P finishing out 59.35 is, it looks like, where we settled out here, so up about 0.4%. Well, Disney announcing it will cut hundreds of jobs in its film and television units. Julia Borson has the details for us. Hi, Julia.
Hi, Morgan. Well, Disney's entertainment division is laying off several hundred employees globally. The company telling us the layoffs are across multiple teams, including marketing for film and TV, TV publicity and casting, and development and corporate financial operations. Now, this is reportedly the 4th and largest round of layoffs that the company has done in the past 12 months that have impacted Disney's TV operations. The company is saying that as the industry transforms at a rapid pace, they're always evaluating ways to efficiently manage the businesses while fueling state-of-the-art creativity and innovation. Now, as Disney does these layoffs, it has been working to make its theatrical releases bigger and to make fewer films for streaming. And analysts seem to agree with this strategy. 3/4 of analysts have a buy rating on the stock. There's only one sell rating currently on Disney. Morgan?
Okay, Julia Borson, thank you. Well, coming up, energy was the top performing sector today after a big jump in the price of oil after OPEC Plus hikes production. Ahead, we're going to hear from one expert who says oil still looks cheap despite this move.
And speaking of hikes, a tax hike looks like it could be a hit to earnings of the 2 biggest online sports books. Those details coming up on Overtime.
Oh my God. Oh my God.
It was just clearly lost, so I was just trying to make moves which kind of were tricky for him, and luckily he got into time scramble. And yeah, one thing that I learned from this tournament is time scrambles can get too much out of control. So
was this a trick that you saw some moves ahead, or was it just something that happened where you were just trying to make things a little difficult?
I mean, yeah, this endgame I was basically trying to get some kind of knight g5, and luckily after king f6, h4, I got this knight g5, and although his king comes to, king walk probably is winning, I have some spite checks, and yeah, I mean, okay, 100 times, 99 out of 100 times I would lose, but
But you didn't.
Yeah, just a lucky day.
How important is it for you personally?
Well, there wasn't much I could do. It was just clearly lost, so I was just trying to make moves which kind of were tricky for him, and luckily he got into time scramble. And, yeah, one thing that I learned from this tournament is time scrambles can get too much out of control. So.
And a budget bill passed in Illinois over the weekend. That bill puts a 25-cent per bet tax on the first 20 million wagers and then 50 cents per bet after that. Analysts expect 2 to 5% hit to earnings. DraftKings and FanDuel control 75% of the Illinois sports betting market.
Well, meantime, oil prices surging today. The energy sector, the top performer, with stocks like Coterra, Devon, and EQT up about 3%. OPEC Plus announcing it will raise the total supply quota for its members by over 400,000 barrels per day for the third straight month. However, that boost ended up being smaller than some had feared. Geopolitical risk factors, though, also giving support to oil as tensions between Russia and Ukraine intensify. Joining us now is Arjun Murthy. He is a partner at energy consultancy Veriton that invests in the energy sector. He's also a board member at ConocoPhillips and Liberty Energy. And Arjun, it's great to have you back on the show. So let's start right there. The jump we've seen in crude oil, how much of this is the OPEC dynamics? How much of this is the fact that we have geopolitical risks specifically around Russia and Ukraine, and also negotiating dynamics involving Iran?
Yeah, it's great to be back. And I think it's not just those two dynamics, but also the fact that oil has been very oversold. There were a lot of concerns that the trade war would lead to recession at a time that OPEC was flooding the market. And we've seen some of those tariff trade war concerns ease. We've seen the hard data, so to speak, hold up better than the soft data. In oil markets, that's refining margins doing better. We're entering a seasonally better period. And all these things have conspired to, I think, cause that sort of oversold condition oil to start reversing here a bit.
So you like oil at these levels? You think it goes higher?
I think we're starting to take off the worst case for oil, which was that we'd test the 50s and even $40 oil if we plummeted quickly to recession due to a trade war and OPEC was flooding the market. We're now seeing signs that faster than they usually do it, E&P companies are cutting back on CapEx. There's more talk and recognition that the best days of shale are increasingly behind us. And I think where markets also starting to recognize the view we've had, which is that OPEC may not have as much spare capacity. Yes, they have some to bring on. They're not bringing it on at an otherwise great time. But maybe we're starting to get towards the end of how much they can bring on after perhaps this increase and maybe one more after this.
Arjun, how exposed is oil to the potential storyline for the back half of 2025 that supply has been pulled in because of these 90-day tariff windows and some consumers, particularly in the working class, are getting tapped out?
I think that's the still key risk period to remain for oil. So as I mentioned, we're going through a seasonally better period for demand, the summer driving season in the U.S., the air conditioning season in the Middle East. These are big near-term demand drivers. I think there is concern that when you get into the fall, that would also be the time where we're going to reconcile, is the weakness in the broad economic South data correct, or will the hard data kind of win the day? If we do get kind of a little bit of a weakening in the hard data at a time of seasonal weakness for oil demand, I think that's your next big risk period. But I might also call that perhaps the final risk period. Again, these signs that shale is peaking and OPEC is running through its spare capacity. You're setting up for a pretty good upside over the next couple of years. You just have to get through this demand choppiness that you're alluding to.
Right, and which makes me wonder if it is just a little bit of choppiness or if the data is just a little bad, might that provide support to people who are longer term bullish on oil and have the price go up because at least the nearer term worries perhaps evaporating?
I mean, that's exactly right. And I think the real question on oil from an investment standpoint is, what is your horizon? If you're trying to be a short-term trader, I think there is legitimate concern to worry about the middle to back half of this year. But again, this shale has been 90% of global oil supply growth over the last decade. And there's no one who believes that we can get that kind of growth going forward. And we're at a time, we're just coming out of all this energy transition mania where people said, hey, we're not going to need crude oil anymore. That is proving to be not true. And yet no one's trying to find oil. Everyone's doing, understandably, stock buybacks, dividends. We support all that stuff. But at some point with global economic growth, when it returns and all the economic needs of the rest of the world, you're going to need an oil supply. Now, is that second half of 2025? Maybe not.
Okay.
But as you get into 26 and 27, I think that's when you start thinking about a stronger potential upside for oil markets.
Arjun, I know you keep saying the best days of shale are over, but I also realize you have permitting reforms happening. You have deregulation happening. There was a big Supreme Court decision that actually moved in favor of enabling more infrastructure to be built in places like Utah. There's a sense from some of my conversations with people in the industry that Utah could be the next big area where you see investment and oil production coming forth as well. How are you handicapping some of those dynamics and what it actually means for U.S. oil production, maybe being more resilient?
I actually love where you're going with this question because this is what's needed. So we are very supportive of having permitting and regulatory reform and infrastructure reform. And we do need to think about, in a world where the Permian Basin is not going to grow as quickly, it's still going to be a big and important basin. We need to look towards Canada, and that requires infrastructure. We need to consider Alaska, in particular, the National Petroleum Reserve of Alaska is a very prospective area, as well as places like Utah. And I might even say California, believe it or not, actually has oil. And maybe they are deciding shutting down the oil industry is not such a good idea. So I think trying to figure out where we can go as a country to ensure that we have a substantial oil production, which has been so beneficial to us, that is going to be one of the big questions. And permitting reform, you're absolutely right, is a key driver of that.
Arjun Murti, great to have you on. Thanks for joining us.
Thank you.
Well, speaking of Alaska, we'll be talking about that a little bit later in the show. And coming up, the trade war causing American shoppers to miss products from China or pay more for them.
In China, they're missing American foods from Chinese restaurants. And what are restaurant goers missing? Spoiler alert, it's something folks eat in the American South, and it's not chitlins. Full story when we return.
Vicious people.
Welcome back. Steel stocks surging today. President Trump announcing plans late Friday to double tariffs on imported steel, also aluminum, to 50%. The new duties are set to take effect on June 4th. Trading partners, including Europe, already threatening retaliation. But Cleveland-Cliffs is the top performer, up over 20% for its best day since 2016. Nucor and Steel Dynamics also shooting higher, finishing up about 10% apiece. U.S. Steel, though, that was the outlier. That was down on the day. President Trump delivering the tariff news from a U.S. steel plant in Pennsylvania. Now, on the aluminum side, Alcoa finishing lower, down about 0.5%, since much of the aluminum consumed in the U.S. is imported, and in Alcoa's case, mostly from Canada to the U.S.
Well, let's stay with tariffs as the U.S. and China go back and forth over which side violated the trade agreement. Consumers in both countries are starting to feel the impact, especially Chinese diners who are having to do without American delicacies like chicken feet. Eunice Yoon has that story in this week's China Lens.
At his restaurant in Beijing, owner Geng Xiaoyun used to offer a special dish, salt-baked chicken feet, or phoenix talons as they're called here, imported from America. But after prices rose 30% from March due to tariffs, he's had to pull the Chinese delicacy from the menu. American chicken feet are so beautiful, he says. Chinese feet just aren't as good. The tariffs and uncertainty they cause is why some American products have been vanishing from stores and restaurants. Beef supplier Liu Li says U.S. beef supply is unstable and now 50% more expensive. He switched to Australian beef, which has zero duty. U.S. beef is fattier and tastier, he says. It's a shame we're in a trade war. The high price is just too much to bear.
I'm taking you to a restaurant in Beijing that is famous locally for its American-style barbecue. It's known to source all of its beef from the U.S.
Until May.
The menu has already been completely changed. The staff here tell us that all of the beef is Australian.
Chinese customers are forced to adjust. I don't think there's much difference, he says. Not everyone is willing to compromise. Restaurateur Geng can source chicken feet now from Brazil or Russia, but says they just don't stand up to the American ones. He keeps a small stash for himself, but hopes to serve his salt-baked American phoenix talons once again. The price of American chicken feet will come back down, he says, as long as there are no big changes in the world's political situation. Quite a feat with U.S.-China tensions so high.
Geng says that another consideration on pricing is that while tariffs are pushing up costs, the down economy here is making Chinese consumers much more price sensitive. So the American chicken foot and its pricier price is a bigger sell. John?
Somebody's got to tell the American chickens. I'm sure they'd be very proud. Now, it sounds to me like, at least in the near to medium term, these shifts won't be permanent because the American food product is differentiated, kind of different from the European situation, no?
Yeah, well, it definitely has its own selling point. So that is something that longer term would be good for the industry. But for the moment, one of the problems is also just that overall uncertainty that people have. And one thing that was interesting with the consumers who we spoke to is that they were saying, well, it's something that we could live with. They were kind of adjusting to it. And one thing that we've learned here during the pandemic is that once people start switching products, over the long term, there's a big question as to whether or not you'd go back. So that's another consideration that a lot of these businesses are thinking about here.
This is giving new meaning to the term game of chicken, Eunice. Fabulous reporting, as always, on all of this. Our Eunice Yoon. Well, it's time now for a CNBC News Update with Julia Borston. Hi, Julia.
Hey, Morgan. A federal judge this afternoon said the Trump administration likely broke the law when it stripped 50,000 TSA officers of their ability to unionize and use collective bargaining. The judge ultimately blocked the Department of Homeland Security from canceling the union contract while a lawsuit by 4 different unions plays out in court. The FDA has approved the first AI tool to help predict the 5-year risk of breast cancer from routine mammograms. In its announcement, the company behind the technology, Clarity Breast, noted that the AI can help because most current risk assessment models use age and genetics, but that 85% of women diagnosed don't have a family history or any identifiable risk factors. And Philadelphia Eagles star running back Saquon Barkley was announced today as EA Sports cover athlete for Madden NFL 26. In addition to helping the Eagles win another Super Bowl, Barkley also took home the single-season rushing record last year. He's the first Eagles player on the cover since Donovan McNabb in 2006. Back over to you.
All you had to do was jump over a grown man. Julia, thank you. Well, stocks higher again today. The Nasdaq, the biggest gainer, continuing its May run. Our next guest warns of slowing growth and higher inflation in the second half of the year. Will that derail the rally?
Plus, what will we learn about the state of the consumer? When the 2 big dollar stores report results this week, we've got your preview when Overtime returns.
Self today.
Welcome back to Overtime. Stocks mostly higher today. Tech leading the way. The Nasdaq picking up where it left off in May, up more than 0.5%. The chips among the top gainers. A potential thaw between the U.S. and China may be helping there. Also, a couple of big deals in healthcare. Sanofi buying Blueprint Medicines for $9.5 billion, and Bristol Myers collaborating with BioNTech on a cancer drug. Outside of stocks, oil up more than 3%. Gold closing at its highest level in nearly a month, just shy of 3,400. And then the 10-year yield at 4.45%.
Well, let's stay on the market. As uncertainty over tariffs and fiscal policy continue, our next guest expects a slowdown in economic growth and higher inflation in the second half. So joining us now is Wells Fargo Investment Institute Head of Global Equities and Real Assets, Samir Samana. Samir, it's great to have you on. Let's start right there, because we have seen a slowdown in economic growth, but we are also coming off of years of record fiscal stimulus. So how much of this is just normalization And how much of this is the calm before the storm of something perhaps more pernicious?
Yeah, Morgan, great questions. And honestly, we won't know until probably Q3, maybe even Q4, because right now there's a lot of front loading of inventories. There's probably a lot of purchases on the part of consumers to kind of get ahead of those tariffs. So we won't know what the actual run rate of the economy is probably until Q3 or Q4. Now, we will go ahead and say, look, we don't expect a recession. So while it will be slower, it's not going to be recessionary, but it will be probably a little bit, again, to your point, not as strong as it was over the past few years, which makes the economy a lot more vulnerable to a shock. So that could come from geopolitics, could come from those long rates, could come from tariffs. And I think that's what worries us, is just the fact that we are heading towards stall speed.
So in light of that, how do you protect yourself from being vulnerable? Where do you invest in this market right now?
So we think you can still pick up 4 to 4.5%, kind of in the short to intermediate part of the fixed income curve, and we wouldn't take on too much duration at this point, given some of the factors going on there. So, what we would do is probably rebalance at a high level from equities into fixed income. If you have, over allocations to areas like small caps, like emerging markets, we would probably pull back there first, just because of the lower quality and the fact that they're more economically sensitive, especially in any kind of pullback.
Samir, we went from equities, from stocks, reacting to the Fed for a couple years up to last year, and then to policy this year. How long does that back and forth between reaction to Fed and policy continue before something else kicks in?
Yeah, look, I think we have moved on really from the Fed to tariffs right now. I think the blow by blow of tariffs over the next few months really will be probably the primary driver of markets. I think the Fed is telling you again and again that they may not cut rates this year. We only expect, a few between now and year-end 2026. So really, that's not the main driver for markets. The main drivers will be tariffs. And then I think, honestly, what will happen with corporate earnings? Who will actually pay the cost of the tariffs? We believe tariffs are taxes, and somebody has to pay them. It's some combination of U.S. companies, U.S. consumers, or international producers and the people making the goods.
So are there stocks, are there industries that are sheltered enough from the tariffs themselves that you feel confident placing bets there that sort of aren't as dependent? Or does the entire global economy hinge on this tariff question so much that there's nowhere to hide?
Yeah, I think in early April, it was pretty clear to see that tech had probably sold off too much on some of the DeepSeek news and on some of just the lower glide paths from an expectation standpoint. Now you've had a very nice rally. So I would say from a timeliness standpoint, energy jumps out to me, still very cheap, not as impacted by tariffs unless there's a recession. Financials, very domestic industry, should see lower deregulation, is enjoying kind of that steepness in the curve. So I would say that's probably an opportunity. And then mid-cap equities. We wouldn't go too far down the market cap stack to small caps, but we think mid-caps are in a little bit of a sweet spot if things come back to the U.S. in terms of manufacturing and production, but also from things like M&A, which could pick up later this year.
All right. Maybe someplace to hide. Samir Samana, thank you.
Thanks, John.
Up next, Brian Sullivan is in Alaska for an up-close look at a nearly $40 billion battle over a natural gas pipeline.
It's only 12:40 or so in the afternoon here, John. This is our second city in Alaska already today. And coming up after the break, we're going to hear from the Secretary of Energy, who is with us, or we were with them, today in Alaska about what is at stake and why Russia is a big part of this story. That's next.
Welcome back to Overtime. President Trump is making a bet on the future of American energy by backing a nearly $40 billion natural gas pipeline in Alaska. Brian Sullivan is in the last frontier with the details and the potential risks and rewards. Brian.
Morgan, we are not just in Alaska. We're at the Arctic Circle. We are at the top of the world. We were in Barrow, Reykjavik earlier today. Now we're in Dead Horse, which is also known as Prudhoe Bay, probably a more well-known name, to talk about this potential $40+ billion pipeline. Everybody knows the oil pipeline. Okay, that's famous. Prudhoe Bay, where we are right now, by the way, all the way down to Valdez, Alaska. There is a new push, a renewed push for this $40+ billion natural gas pipeline. Take some of the gas that's out of the ground here, put it in a pipeline right next to the oil pipeline, down to the sea, turn it into liquefied natural gas, sell that to Japan, Korea, Taiwan. By the way, not only here with Secretary of Energy, Interior, EPA Administrator, Governor of Alaska, Senator Dan Sullivan, but also representatives from Asia, Japanese, Taiwanese, Thai, Filipino, Korean, others. Those buyers are all here. Now, whether or not the pipeline ultimately gets built, that's a question that only time will tell. ConocoPhillips, ExxonMobil, some of the names that are based here, that have operations here, they've been non-committal. I've reached out to pretty much all of them about whether or not there will be capital, their own money invested. So we asked the Secretary of Energy, what role does Russia play in making sure that this pipeline ultimately may happen? And here's what he said.
This pipeline itself is probably roughly equal to 40% of Russian LNG sales today. Just this project would displace a good chunk of Russian LNG, liquefied natural gas exports. But absolutely, the United States can fill the gap of the entire Russian exports. But that hasn't happened yet.
So we sell more gas, Russia sells less gas, they have less money, we have more money. That, I think I summed it up pretty well, Morgan and John.
Yeah, and I think that gets at such a key macro topic in all of this, Brian, and what you being there highlights, and that is the role that LNG can play not only in trade talks, but also in peace talks, or at least ceasefire talks, given the geopolitical backdrop.
Here's the dirty secret, and we've said this for years on CNBC. We've shown this to you from Europe. The Nord Stream pipeline may have gotten blown up, but Russia's selling more LNG, liquefied natural gas, than ever. That is adding more money to Vladimir Putin's coffers. The BBC a couple of days ago just did a story on how much money that Russia and Putin are making from LNG. So some of the idea is not just use the gas that's here, don't burn it off, but also sell some of that gas, take some customers from Russia, and give Russia less money at the same time. Sounds like an easy win. The problem, guys, is that the pipeline at 45 billion. A lot of people in the industry that I've talked to on and off the record have said it's a great idea. It's just simply non-economic because the economics of this place have changed a lot since they built it 50 years ago.
That's the tariff and Trump administration angle trying to get Japan, South Korea, and Taiwan to foot part of the bill here, right?
That is it. Some of those representatives, John, they are here on the same sort of trip that we are. They were not in Reykjavik, Barrow, yesterday, but they're here in Prudhoe Bay now. And tomorrow there's a meeting and conference in Anchorage, Alaska, where we're going to go to tonight, which is effectively, can you pony up the money? I mean, that's it. Everybody agrees it's a pretty good idea, but the difference between, what do they say, a contract and commitment is a check. Will somebody write a $10, $20 billion 30-year check that would effectively fund this pipeline getting built? By the way, very quickly, Alaska's actually running out of natural gas down south. So a domestic part of the story is just making sure they have enough gas to power their own economy, even outside of selling it to Asia. It has been a mind-blowing, eye-opening experience. It's about 10 degrees. There are some really tough, good people who live and work up here. This is a whole part of the American experience I've never seen and couldn't have imagined, but it's amazing. It really, really is an amazing trip.
Yeah. Well, Brian, wonderful reporting today, and thank you for bringing that to us here.
Sure.
Stay warm.
Okay.
Brian Sullivan. Well, space stocks falling back to earth after President Trump scrubs Jared Isaacman's nomination to run NASA. The potential fallout for the commercial space industry. Next.
Plus, healthcare has been the worst performing sector over the last 3 months. Mike Santoli is going to take a look at whether these stocks are starting to look cheap when overtime returns.
Welcome back. Commercial space stocks underperforming today. Shares of Rocket Lab, Planet Labs, Redwire, Intuitive Machines, all closing in the red. Why? Well, President Trump over the weekend pulling his nominee to lead NASA, a name overtime viewers know well. Jared Isaacman, founder of fintech company Shift4 and a two-time private astronaut via Elon Musk's SpaceX. Isaacman had been viewed by many in the space community to be a smart pick to reinvigorate and reimagine NASA and how it contracts with companies, even amid an effort to both return humans to the moon and spearhead missions to Mars, and despite the fact that record budget cuts are being proposed by the White House. Now, Trump writing in a Truth Social post that he was pulling Isaacman's nomination, quote, after a thorough review of prior associations. Isaacman had previously donated to some Democrats, which had been disclosed to the White House months ago. The tech billionaire had been poised to be confirmed as soon as this week. John?
All right. Surprise there. Well, let's turn to healthcare. The sector is among the worst performers, not just today, but for the year, putting at risk its status as a haven from macro stress. But is this underperformance an opportunity to buy? Let's get back to Mike Santoli for more. Mike?
Yeah, John, it's one of those situations where just how contrarian are you? Take a look at the healthcare sector on an equal weighted basis. That's this right here. This is a 10-year chart because I wanted to show how it mostly traveled in sync with the S&P 500 for most of this period before flagging and actually underperforming closer to the tune of the consumer staples sector, which is the real laggard here and hasn't done anything in absolute terms for years since the pandemic. On a valuation basis, pretty similar story. Healthcare has caught down to consumer staples. This is the PE, forward PE for each sector relative to the S&P 500. So right now, these stocks as a group traded about 70% of the broad market's PE. Obviously, huge questions about policy, regulatory shifts, business model threats to things like managed care, as we know from the UNH situation. The question is all this discounted, and exactly how does it play out from here? These are now pretty small proportions of the S&P 500, I would also point out, so they don't really drive the overall index. Maybe a lot of investors feel like they can just ignore them, Morgan.
All right. Mike Santoli, thank you. Dollar store stocks have been red hot this year. Up next, a top analyst on whether there's still more room to run as Dollar General and Dollar Tree get set to report earnings this week.
And don't forget, you can catch us on the go by following the Closing Bell Overtime podcast on your favorite podcast app. We'll be right back.
Welcome back to Overtime. Meta, a big winner in the S&P 500 today on a Wall Street Journal report that the company plans to use AI to fully create ads by the end of next year. Advertising stocks getting hit hard as a result. You can see right there, many of those names lower today in trading.
Yeah, for sure. Turning now to retail, more earnings on tap for tomorrow. Before the bell, we get results from Signet Jewelers and Dollar General. Later in the week will be Dollar Tree's turn, and joining us now is Michael Lasser from UBS. Michael, you like these names overall, it seems, but I'm wondering about this trade-off between consolidation that might help some of the players that are still standing versus reductions in SNAP benefits and just the overall stretched consumer that could reduce their ability to pay for anything.
So, John, it's a good question. We think the environment for the dollar stores is more favorable than not, meaning the upside opportunities are greater than the risks. Specifically, over the next couple of days, as Dollar General and Dollar Tree reports, we expect two key factors will drive upside to the sales estimates, which will then translate to better earnings. That includes better execution as well as some trade down for the very reason that you mentioned, that it is a challenging environment for the consumer and they need to stretch their dollar. And there really is no better retailer around than Dollar General and Dollar Tree outside of Walmart to help the consumer stretch their budgets. And we think we'll see signs of that this quarter.
How much control do they have over their costs?
They have a good amount of control. Dollar General, the abundance of what it sells is sourced domestically. Only a very small percentage is sourced from overseas. Dollar Tree, about 1/3 of what it sells is sourced from China, or at least it has been historically. There's a case where it's going to need to take some pricing in order to offset the tariffs that are in place on those goods. But with that being said, it's shown an ability to pass along increased costs in the past, and we expect it to do the same. It's still going to look relatively attractive both on an absolute and relative basis. So the value proposition in the mind of the consumer should still be quite good, even with modest amount of pricing that Dollar Tree has to take in order to offset the tariff.
So is the way to think about this that even if you are talking about modest pricing at Dollar Tree, it's outsized impact on Shein and some of these other Chinese e-commerce players who basically bring inventory in to deliver almost as soon as the order comes, and the fact that they're getting hit harder, so that therefore makes some of the American retailers that are still at least somewhat dependent on China more attractive here?
I like the way you're thinking, Morgan. That's exactly right. The fact that the de minimis rule has now been changed such that Temu, Shein have to pay duties on the goods they were bringing into the U.S. makes the dollar stores more compelling, where their price gaps with others are lower. And so we think that the consumer is now more willing to spend at Dollar Tree and Dollar General, and in lieu of going to some of those Chinese e-commerce websites, and that is going to help not only this quarter but in the forward quarters ahead.
Are we still overboxed as a nation? And I ask that knowing we've seen a number of bankruptcies in recent months.
Yeah, we are. We have way too many retail stores in the United States. There's almost 1 million retail stores. We expect over time that to go down below 900,000. What that will do is benefit the well-positioned larger retailers. We expect Dollar General and Dollar Tree to be in that beneficiary bucket, especially as retailers like the drugstores, the department stores, and others close locations. That will just put more volume in the hands of those that are either have their full store base that is ongoing or even opening more stores like some of these dollar stores.
I think of these players as neighborhood strip mall mainstays. Maybe that's wrong. Tell me, how exposed are they to being just in the wrong place physically?
So Dollar Tree is definitely more traditional retail, suburban strip center focused. Dollar General tends to have more of a lean towards rural locations. I would not say that the real estate of these companies is ill-fitting or ill-prepared for the current state of the environment. I think the opposite is true, that they stand to benefit from other store closures around them. So the real estate's in a good spot. There is some debate on how many more dollar stores we do need in this country, given how rapidly they have expanded over the years. But as there is more consolidation in the sector, that will create opportunity for these retailers to expand into those locations. and the overall number of stores can still go down, even as the dollar stores become a bigger portion of the retail sector.
Okay. We're going to watch all
Thank
of
you
this
very
this
much.
week with earnings. Michael Lasser, thank you.
Good to see you.
Outside of retail, we'll get earnings from a few tech names, too. We're going to hear from CrowdStrike, HPE, and Asana after the bell. And on the economic front, we will get the April factory orders report, the April job openings and labor turnover survey jolts, and May's auto sales as well on this first trading day of June.
Yeah, the crypto stocks are on quite a run lately, so it'll be interesting. I said crypto, I meant cybersecurity. Stocks have been on quite a run lately, so it'll be interesting to see how they perform at and after earnings.
Yeah, that's been a secular growth story as well, and a dangerous world has helped to propel that further, as has AI implementation. Well, major averages finished higher. That does it for us here at Overtime.
Fast money starts now.
Rundown doesn't stop you. Live in the Nasdaq market site in the heart of New York City's Times Square, this is Fast Money. Here's what's on tap tonight. Housing headaches from builders to construction equipment to home furnishing, a wrecking ball coming for anything in the housing trade today. Can the group get back on solid foundations? We'll debate that.